Hi, in this video, we are going to try and decode the equation of GDP or gross domestic product. We have all come across this equation of GDP, which is calculated using the consumption or expenditure method that works like G plus C plus I plus X minus M. How does this equation come? What are the key components of this equation? And how do we read this equation to understand what's really going on with an economy? And what could be future steps for the country in order to improve this equation? Right? So let's start first with the genesis of the equation. Where does this come from? So GDP, as we know, is the gross domestic product, which is the sum total of the output of goods and services that is generated within the geographical boundaries of a country. So if you're looking at India, anything that is produced as a good or a service and is sold in India is basically going to be, loosely put, the component of gross domestic product that is going to be there. Now there are typically three methods of calculation of GDP. You could calculate it using the entire output of the country, which is the final production of goods and services that is there. You could calculate it using the consumption of the country, which is how much has actually been consumed essentially. And there's a slight difference between the two. We'll see where that comes from. Or you could calculate the sort of cumulative income of everybody in the economy. Right? If I add up the income of all individuals and entities in the economy, the sum total of that should also give me the GDP essentially, right? Now, the equation that you see on the screen is essentially the consumption, or what is also commonly called as the expenditure method of GDP calculation. So we're looking at expenditure of the entities in the geographical boundaries of India to arrive at the GDP equation. So let's try and understand this first. If you look at the consumption in a country, any consumption in a country has to be done by broadly three entities, right? Either the government could do it, right? Or individuals like you and me could do it. So that's going to come under consumption. Or businesses could do it. So that I stands for investment and that comes there. So you could either see government spending, or you could see private spending, or you could see business spending. Between these three, every consumption or expenditure that has been done in the economy would be accounted for. There is no fourth entity. However, there are a couple of adjustments that are needed, right? What if there was a good that was produced in India, right, but not sold in India? This was sold outside India. This is exports. And remember, because you're looking at gross domestic product, essentially the production in the economy, whether you consume it in India or not is immaterial. Right? So if you're basically looking at India's economy and the GDP for India, whatever you have produced, even if you've sold it outside India, that component is going to be added here. Consumption method directly isko record nahi karega because ye India mein consume nahi hua hai. Right? This consumption has happened outside India. So you have to account for adding of exports. There's another adjustment that is needed. There are goods that might be sold but not produced in India. Right? What if you've sold something but not produced in the country? In this particular case, that would be an import, right? Think about it. If let's say there's something that is purchased in India for 100 rupees by me, and I sell it to you, I import it for 100 rupees in India and I sell it to you for 150 rupees, your consumption will record 150 here because that's the consumption receipt that would have come. But the value add in India is only 50. India mein to sirf 50 rupees add hua hai, right? So in that context, I have to remove the 100, which is where I have to subtract the import value. And that's why imports are subtracted from here. So that gives us four components to this equation. If you look at this equation, there will be broadly four components. You have the government spending, you have private consumption, you have business investments, and you have X minus M. There are some minor adjustments as well. There are there when the government comes out with the reports. They classify 2 or 3 line items more here. I'll explain that as we go along. And the nomenclature of these line items is also slightly different, right? Now, which one of these is the most important and how do you really decode that? Let's first try and understand India's GDP components, right? So this is the report that the government comes out. If you want to find this report, you can go on this website called MOSPI, Ministry of Statistics and Program Implementation. And you'll find the data coming out there. They come up with press releases with the national income. This is nominal GDP data. How do I know that this is the nominal GDP data? Because this is at current prices. and these are the second advanced estimates for FY22. That's the second advanced estimate for FY22 gross domestic product. Why advanced estimates? Because we've just received this data. Now at the end of the year, we will see the sort of provisional estimates and then revised components finally that will come out. So total GDP for India is 236 lakh crore, or 2.36 crore is what you will essentially see this data being for the current financial year that has just ended at the time of recording of this video. You will see some components below this. When you see the expenditure components here, you see private final consumption expenditure, that's C. Government final consumption expenditure, that is G. Gross fixed capital formation, this is akin to I. And when you usually look at I and you talk about it, you also look at something called as change in stock, CIS. Remember, we saw two components. What is produced in India but not sold in India, that's exports, sold outside India. What is sold in India but not produced in India, that's imports. But what if there's something that is produced in India but not sold anywhere? This is going to get added in the inventory. That's the change in stock. Typically, for all common purposes, we just combine these two values. So I is kind of referred to as GFCF plus CIS in that context. Valuables, which is gold and silver, is kept outside of it. You see exports and imports. So exports minus imports is the component. And then you calculate GDP using various sampling methodologies. So if your calculation of GDP by one method is slightly different than the other one, then you will have discrepancies which are sort of rounded off as errors there, right? Now, which of these is the largest for India kind of also gives an insight into policy making for India. So look at the components. Share in GDP, this is C. Nearly 60% of India's GDP is derived from consumption, right? Then you have government expenditure. Then you have investments, which is about close to 30% or so. And exports minus imports, if you see, this would basically be -2 approximately. This is X minus M. We are a net importer, and this component works out to X minus M that we are looking at, right? So we are seeing that consumption is about 60%, investment is approximately close to about 30%, this is about -2%, and this would be approximately close to plus 12%. Now just try and decode this and try and understand as to policy making in India. In an economy where out of 100 rupees of GDP, 60 is consumption, from the government's point of view, everything that you do should be trying to boost consumption. If you are able to boost consumption by 10%, this goes up by 10%, you know that your GDP will definitely grow by at least 6%. That's a 6% spike straight away because your consumption has gone up 10%. So you look at almost all the policy making of Government of India, you'll realize that, even things like MNREGA, for example, it is imperative for the government to ensure that public keeps spending, because that is what drives our GDP. That is an internal consumption driven economy. And that's why we say India is a consumption driven economy that basically, thrives on this domestic consumption that goes on. Having said that, from a longer term standpoint, and, break it down into these four components, G, C, I, and X minus M. X minus M is not in our hands. I mean, we can strive for it, but the reality is for us to export, somebody else has to import. Everybody in the world wants to be a net exporter, but that's not possible, right? Because for somebody to be a net exporter, somebody else has to be importing, and on balance, some countries will be net importing and some countries will be net exporting. So I can't change this situation overnight, even if I wish, right? It takes time, and you need a competitive advantage globally. Just because we want to sell something elsewhere in the world doesn't mean it will get sold elsewhere in the world. So this usually is not a very easy lever to change overnight. Government spending usually is your last resort. You don't want the government to keep sort of spending, because the day they stop doing so, it starts damaging the economic revival in that context. So you're left with C and I. Now remember, you can give a lot of money to the people of the country and they can keep spending, but the moment you stop giving them the money, they will likely stop spending. You want the spending to be sustainable, which will only happen if there are enough jobs in the country. So I, which is business investment, and C, which is consumption by private individuals, go hand in hand. If you increase consumption, likely scenario is that you will see demand for products that should increase in a way the production in the country. And when businesses understand that production needs to be increase, they will add capacity. When they add capacity, there will be more jobs. When there are more jobs, you will automatically see consumption going up. Vice versa is also true. You could push a lot of investment in the country, like what the government tried to do essentially with the corporate tax rate cut. What they were trying to say was that instead of us spending, collecting in taxes and spending it under the header of G, we would give a sort of a rebate on taxes, and the businesses need to spend that money. If they spend that money, they will create jobs. If they create jobs, there'll be more consumption. If they create more consumption, then automatically the economic cycle goes on. So C and I go hand in hand. It is imperative that the government keeps focusing on the investment environment in the country, because only when businesses spend is when jobs will get created. Only when jobs get created is when you will see consumption going up. In some senses, India is actually a remarkable economy where a lot of the consumption actually happens internally, and we're not really globally dependent, which is why if you look at the 2008 crisis as well, and even after that, if you look at general global turmoil that has happened, barring the consumption of oil on which we are dependent on global prices, for all other segments, we are largely self-sufficient, and a lot of the demand actually comes from within India. This is also one of the reasons why, because we are a consumption driven economy, why almost everybody wants to be in the B2C segment in India, why you see so many startups coming out on the B2C segment in India, and why you find that companies that are operating in the B2C or the consumption theme in India get very high valuation multiples. You look at the names of companies like HUL or Nestle or D-Mart, a host of these, or Titan. All of them get their valuation multiple purely because this economic consumption theme in India is going to continue for a long while, and this opportunity continues to be huge, and we are sort of self-sufficient in terms of generating this demand within the economy. That's in a nutshell the components of GDP. How do you decode it? This is a very simple yet extremely powerful equation. It can tell you that in times of turmoil the government will have to increase spending, and when the government increases spending, how does that flow into other components of the economy? It can tell you whether you are a net exporter or a net importer, and what else do you need to do in terms of your steps in order to ensure that GDP continues to grow significantly. Just think about it in terms of what all can be done in order to revive the GDP growth or continue to have a decade-long GDP growth in India. And do mention your thoughts in the comment section as well. That's broadly it from me in this particular video. Thank you.